Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have a busy show. We're going to obviously talk about our Primary Vision Frac Spread Count. We're going to provide an update on what's happening with Colonial, what's happening in Israel, Gaza, and then a little high-level talk about what some of the recent data coming out of the U.S. means, especially for the consumer and for energy. So just getting right into it, we had another little increase of 2 frac spreads coming in at 223. So it was a little bit of an adjustment. You know, the Permian is back up again, which we were expecting, because as we were saying, the Permian, it's more about just what is active right now. So we went down, and that's moving things into another location. Now they're back up, and this is what we continue to see. And in our recent comments, we really talked about how we're really tracking 2017 when you look at that rate of change, where we're following that. Obviously, we're not at the same level, but we don't need to be, because we don't need the same type of gas spreads to maintain production at these levels. So the focus is really shifted to that oil spread. You know, as the Bakken came out and showed a small increase in oil production for March, but again, it's by 20,000 barrels. So we're talking about a margin of error here, because at the current spread count, we're really not going to see it. I mean, we're not going to see growth at all, but we're really not going to even see production, starting to decline. So that's where we want to try to offset. How are we going to protect that? So the Permian is going to be the one to watch for that national growth, but then some of that uplift is going to come from the Bakken, from the Eagle Ford. So when we shift over to that 3-month range, you can see how we've started to kind of flatten out. Now we're creeping higher. Our view is that we were going to hang around 220 through, let's say, the middle of May. And then as we start getting into June, we're going to start to see that acceleration, just as we normally do. June, July, and then July we kind of peak towards the middle end of the month. And then August, September continues to see that growth. And then as we get into October, you get the seasonality. And then when you get into November, December, you have the holiday breaks. So this is, we're going to see something very similar, but we will see this acceleration. We had a record amount of permits that came out earlier last month, which is the 2-year high. We have more rigs coming back, because this is what we've been talking about. The rigs are coming back now because the focus was wholly on, let's stop decline curves, let's focus on completions, and now we can start bringing back rigs, replenish some of this DUC count, and then we'll see that push towards the end of the year. Now, obviously, we're looking at 2020 versus 2021. So 2020 obviously continued to get ugly into May, and we're actually coming up to the point where we hit that low. But we expect to see a little bit of an acceleration, not so much in the next 2 weeks, but as we start getting into June, we're going to get that push higher. Those that listen to the NOVE call, the National Oil Well Varco, and some of the others, you're seeing that the conversations are real. The conversations are all about, okay, well, we need a couple fluid ends. We're going to need a transmission overhaul. We're going to have a new pump. These are the things that are being talked about. And when we talk about it, it's like, okay, you go to NOVE. NOVE is going to say, look, it's 10% more expensive. So Liberty is not going to be able to pass through. They're going to try to pass through all that cost and maybe get a little premium on the back end. But the E&Ps, like all of this labor cost, that's all a pass through, and labor is becoming a bigger and bigger issue, as we've talked about and as we'll talk about in a little later. And when we talk about labor in the completion side, we're obviously talking about who's on site, who's doing the fracturing, who's doing the drilling. But there's also how are you getting the stuff to that wellhead? How are you getting the stuff to those locations? And this is just looking at what that the cash shipments index is showing. It's had a little bit of a pare back on an aggregate level, because when we look at the index fell 3.1% month over month from March into April, giving back some of that March push. But we won't talk about year over year, because obviously that's going to be something very different. But when you look at the month over month, as we talk about in the EIA show, especially segment 2, week in and week out, the strength is continuing, and we're seeing a big acceleration in May. So we're expecting this to come back up. But even though the shipments in this number have kind of flatlined, when you look at freight rates, they're just going up. And again, it's the pass through on diesel. Diesel prices are up, so you're passing that through. And the same thing can be said about fracturing. When you look at the completion crews, they're passing through the additional equipment, they're passing through those additional costs, and they're trying to get a little bit of premium on the back end. But like just to kind of put this into perspective, so 3.4% month over month on a seasonally adjusted basis in April, which is 3.5% month over month increase in March. So you're seeing the trend is compounding and is accelerating, which is why when we talk about inflation, we're never just talking about, oh, look at the CPI, this is what the consumer is experiencing. We're looking at the full supply chain. We want to watch it from the start to the finish, because if this is accelerating, well, that means that the wellhead is going to get more expensive, which means that costs are going to get passed through. So you're going to see that continuing. And then eventually, as it gets to the consumer, you're going to see those price increases, as we talk about with prices paid, prices received, and as we'll show with import-export prices. And what else is driving this? And this is going to lead us into Colonial as well. There's a shortage of truck drivers. So if you remember in 2018, we had a massive hiring spree. There was a lot of growth. And then through 19, we had over-levered companies that went bankrupt. There was a big one towards the end in December, where about 5,000 truckers were just stranded. And now we've seen this really about face and now pivot, because the inventories are so low, not just in the US, but around the world. So you're getting this huge demand for drivers. And demand for drivers equals more demand, is you're going to have to pay more. So now we're getting $5,000 sign-on bonuses, an increase in hourly wages, and this is the biggest problem. So let's just take Colonial as an isolated incident. So when you look at Colonial, the residential or the local gas station is out of product, but the rack that it comes from is fine. There's more than enough fuel. It's the truck driver to get it from point A to point B that just isn't there. And why is that? Well, when you look at 2020 and you look at COVID, there was less demand. So less demand at the pump means that you have to move less product. So instead of needing, let's say, 5 drivers, you need 2. So you furloughed 3, and then things didn't get any better. So then you let 2 of them go, and now they're working construction, or they're driving trucks for construction companies, and they're making good money. So you have to attract them back somehow, and it's always going to come down to price. But again, where do you try to cover that cost? Well, you cover it in the price that you're charging, because fuel and labor is a pass-through. And that's why we continue to talk about how the consumer prices are going to continue to go up until the consumer rejects it, and we don't think we're there yet. And this isn't just a U.S. problem. Just taking an example, so in southern India, there was a force majeure until May 24th after operations were severely affected from the pandemic, which isn't surprising. And it's a mixture of 2 different things. It's one, they don't have the people to man the ports to get the unload the boats, but they also don't have the drivers to put those containers onto. So this is the same thing that happened in California, throughout the U.S. It's just happening again, which is why when we talk about supply chains normalizing, we do not think this is it's going to happen in the near term, because we continue to see these residual issues coming through the system. Now, pivoting a bit into what is happening in Israel right now, we always want to touch on the Shia crescent, because the Shia crescent is so important when you're considering where is the future of Shia, Sunni, Israeli versus Muslim. So when you look at Iran has, this is an older chart, had built a fairly strong proxy area, from Yemen with the Houthis into Iraq with actually the Houthis again and some other smaller entities, as you get into Lebanon, and then when you get into Gaza with Hamas. This is where we continue to see that. But what has been happening? Well, Trump took away the nuclear deal that starved a lot of capital. Things continued to get worse. And now Trump did part of that. The fact that oil prices collapsed also helped, obviously. So there's some of these benefits in terms of kind of putting that strain on the finances. But what happens when you strain finances? Well, you can't give your proxies the money that they need. And then you start to see some breakdowns. So it's important to look at Iran as it is, and what have they done? They attacked. They were harassing U.S. assets in the Strait of Hormuz. Then you also look at Karbala. Now I talked about Karbala because of its importance. It's in Iraq, and it's the third holy city. It's the high holy city for the Shia Muslims, and the fact that there is such a pushback and there's been riots, and it all started when an activist was gunned down and killed, which again brought up this whole component of the Iraq Shias. Now they are Shias. The Iraq Shias essentially said you need to stop intervening. You're causing bloodshed. So you were continuing to see this pushback. Then you turn over into Israel, and as we talked about on our Thursday show, we highlighted how it started. But now we talked about how it started. Well, how is it going? So when you think about Iran trying to stay relevant, Israel has been striking at will in Syria. Well, now they're trying to form some sort of strength. So what has happened so far? So in the last 2 days, Hamas has launched over 1,500 rockets into Israel, targeting large population areas, but they're also targeting areas to impact travel, shutting down airports, limiting the daily life of those within Israel. Now, this is something that has been increasing, and the Iron Dome, just because a lot of the problems started April 13th, they moved the Iron Dome batteries into position into the south in order to address this. But when you're shooting down rockets, you have to have the missiles to do it, and there's more rockets than there are missiles, which is why they've called up 9,000 reservists. They've amassed tanks on the border. The problem is when you look at Gaza, Gaza is a very densely placed. There's about 20 to 30,000 armed Hamas militants. So it's something that would cause bloodshed. So that we're trying to see some way to counter what could be a very aggressive and bloody ground operation. And they're trying to do this in different ways. So Israel has now struck several tunnels. They were able to take out another 2 launch sites. The problem is the launch sites are in highly populated and very sensitive areas. Like one of the tunnels was next to a kindergarten. And not only do they have to be precise, but sometimes they're so close and they're always populated, you have to use ground forces. So these are different conflicts. The bigger issue, because if you think about Gaza and Palestine and Israel, as long as it's at the government level, we think that this will fade. The bigger issue is at the citizen level. So we have Israeli Jews and Israeli Arabs that are starting to fight with each other. So now we're seeing fights within Israel. And the problem is if you get this ground surge where you get this animosity bubbling to the surface, that is much harder to control than if you just have governments fighting against each other. Right now, we're comfortable in saying that there will likely be some sort of ground movement, especially because there's been 3 launches from Lebanon. They have now cut down part of the fence in Jordan, which has pushed people into the West Bank, which again is going to cause additional issues between Jordan and Israel. Lebanon, the military was able to find several unfired rockets. That has stopped, but there have been 3 launches also from Syria. So you can see how this is starting to span out, which is why it's going to be a lot, and we're going to have to really try to lock down what's been happening. Now, just some generational dynamic comments. There's something called the 58-year rule. And that just looks at, typically after an ethnic civil war, it takes 58 years to have another one. And not to say that you have to have one, but it's the generational cycles. The people that fought that bloody battle, they never want to fight that battle again. So, but what happens after 58 years? You retire, you are older, you pass away, and now you have a new generation that doesn't remember the bloodshed. They remember the atrocities that were done by the other ethnic group against your group. And then you get this resurgence. Now, when we look between the Jews and Arabs, it's been 73 years. So you can think about, as we get nationalism, as we get, post-COVID, struggles on food, as we keep talking about with food insecurity, food expenses, because if I can't feed my family, what does that mean? And that's why we always go back to the quote of, I don't fight because I hate the man in front of me, but because I love those behind me. And that's something that I think is lost at times when we look abroad. But now enough on that. Now we can shift back into the Colonial Pipeline. We made a call on Wednesday that we were going to have at least one line coming back on by Friday. So far they are in the process of restarting both. It's obviously going to take time. Nothing happens overnight. So we've started to see it. We've had anywhere from 10% to 80% of gas stations that have run out of fuel, everywhere from Virginia to DC. DC is the highest at 88%, and the rest are anywhere between that 10% to 60. It's going to take time, but it will get adjusted. Please don't panic. Don't rush out and buy gasoline, because it'll take time. It is there, and we do have that surge of imports, which will come in. And then there's been several waivers to the Jones Act. The Jones Act, for those that don't know, a Jones Act vessel has to be made, manned, and flagged in the U.S., but the Valero put some refined product on foreign vessels with the hope that it would be waived. It got waived, which means that foreign vessel can go from a U.S. port to a U.S. port. That's going to continue. And then at the same time, we have another VLCC coming into Rotterdam, and we'll talk about what's happening in Rotterdam and what's happening in Europe when we look at their build out in refined products, because there is a lot of refined product and it continues to flow from Asia, because Asia is where we continue to see the softness in that physical market, and it's being dumped into the U.S. Now, on the positive side, Europe's imports of U.S. crude is actually going back up. So we're going to hit about 1 million barrels a day in May. And this isn't going to change our estimates of 2.6 to 2.8 million barrels a day of exports. Instead, it's just going to shift. Instead, we're getting less being sold into Asia and more of it being pushed out into the European markets. So now, when we look at what's happening in the global world, when we look at Nigeria, this is what we were talking about, where we've gone from 1.62 million exports in May to about 1.76 million a day in June, with July that should be coming out, not so much next week, but the week after, where when we look at Angola, we're going to get the new loading schedule for Angola next week. The bigger issue overall is Nigeria has yet to sell at least 25 cargoes for June. So we've almost had an all stop, which is becoming a much bigger problem, because we've seen price cuts come into both Nigerian and Angolan cargoes for June. So right now, 25 out of the 56, and Nigeria built up a similar one, which is what we talked about in May, loading in May through mid-April, and a lot of those cargoes were sold at a very steep discount, or steeper discount, and were sold into Europe. Now, as we have Singapore that is back into some sort of lockdown. As we keep talking about with Southeast Asia, we keep seeing more and more lockdowns in those regions, which again is just going to shift that crude that's sitting in West Africa that would be going into those regions into Europe as well, which even though we're going to get more demand from Europe as they awaken from from COVID, that's going to take some time in general. So now when we look at Angola still has 6 or 7 June cargoes to sell, which is one of the things where we've seen that pace really slow down, which is just putting that additional pressure in the physical market, which is why when we look, even though West Africa is really weakened, we're still seeing a discount. We're still seeing Dubai and the Middle East at a discount to West Africa, which again is just promoting more to come from from the Middle East versus West Africa. Iraq just came out and said that they gave full allotment to Asia, which again just speaks to kind of that flow and that competition in the underlying physical. But then when we look at some recent sales, Chevron actually sold CPC blend at $2.35 less than dated Brent. That had initially been at about $3.50. So you can see that we are starting to get a little bit of tightness, but it's just by grade, and that's something positive to see, but we want to see that continue up, which we don't think is likely just given some of the pressures that remain in West Africa. Now, when we look at what happened in China, you can see that there's starting to be a little bit of a drawdown, but we're starting to see VLCCs and super tankers come back into the Chinese markets. Seasonally adjusted, we're still at all-time highs. Fuel oil is similar. We've started to see that come down a bit, but still remain at an elevated level. And the reason why, when we shift over to refinery run rates, when we look at state-owned refiners, now this is as of May 14th, so we still have some maintenance, we still have some turnarounds, but we should start to see some of that come out. But we've seen run rates come down a little bit of an increase of about 1% in the teapots. But as we keep talking about, the teapots have been sanctioned, they're being investigated by the government. And it's really something that's happening because they want to protect SOE margins. So by protecting the state-owned enterprises, they're going to sacrifice teapots, and they're just not seeing a lot of demand at the Chinese level, at the consumer level, and PPIs continue to go higher. So they're trying to find ways to manage some of this price and some of this cost. And the teapots typically try to bring in a decent amount. So if we look at pricing, they may try to do more in terms of the teapots. So we might see them get a little bit better in terms of just where their rates are in order to try to keep some of this product, within the country and try to protect some of those prices, bring some of those costs down. It's just going to be very difficult just given where activation is, and storage is already so elevated that it's going to be hard to see too much more activity without utilizing the export market. And they're trying to cap those exports. And when we look at the reason why they're trying to cap those exports, we can shift to Singapore, which continued to have another increase in total stocks. We went from 52.6 to 52.7 after that big bump that you can see on that yellow line. And we're continuing to see residuals stay elevated, but the bigger increases in light distillates, which is going to continue based on what we're seeing out of India, Southeast Asia, which is again shifting into Singapore and then shifting again into the Atlantic Basin, keeping us well supplied, well stocked, and is just putting those headwinds on where our product is really going to go. And we'll talk about that more as we go into the EIA show next week. This is another one we're just going to touch on. There were drawdowns across the board. There, as we talked about, there are those VLCCs coming into the European markets. That's going to be a benefit in general in terms of kind of backfilling as we do get some more activity coming into Europe. But the biggest issue is going to be gasoline, because this number is including the exports into the U.S. Now, it doesn't cover all of Colonial, but it covers some of it. And you can see even with those exports, they're only down that 31. And you can see that we should be. So if you just look at that 13-year line, there should be a drawdown. And you can just see that it's starting to move in that direction. But based on rate of change, the slope is very similar. So they're still not working through this glut, which is going to limit how active their refiners can get. Now, just providing some high-level views of the U.S., you can see that retail sales were a big swing and a miss after we had the large stimulus, which is what we were talking about. So we said last month you're going to get a huge pull forward of demand, and then you're going to get this big drop down in retail sales. Now, everybody really knew that, so the fact that it was known and we still missed estimates is just pointing to some of the softness. And then when we look at import and export prices continuing to go up, continuing to drive higher, just speaks to just the pressure that remains in the system. And when you look at those prices, those increases, and then you look at jobless claims, which came down a bit, but continuing claims went up, then look at sentiment. Well, you have jobs that are concerning. You had that big miss that we talked about in the econ show. Now you have that stickiness in the unemployment rates, and you have inflation going up, so people are not feeling as well. So now when you look at the sentiment, you're seeing that it's starting to roll over a bit. University of Michigan sentiment was expected at 90, came in at 82.8. But the bigger one is always going to be inflation, where the expectations for inflation continue to ratchet up. And they typically follow pretty closely with what they're seeing at the pump. And as we've been talking about between Colonial and just the issues abroad, we're really going to continue to see gasoline prices get elevated. This is one that we always talk about because this is going to show you the actual underlying piece of what's happening in the claims. And we always point to the pandemic unemployment insistence and pandemic emergency. So April 17th, we came down to 16.2. Now we're right back up to 16.9. And this is what we've been saying, that we're going to kind of live in this 16.5 to 17 million, because there's just not that, there are jobs, but there's a huge disconnect between jobs available and skills. And until each company or the employee is willing to accept that, we're going to continue to see this bifurcated market, which is why, again, when we come back to the consumer and spending, we get a little concerned. And then when you're concerned about, well, you can say in your head, well, the employees should just accept less money because they don't have the skills, so they have to get trained. But look at inflation. This is just showing you what is yet to come. Because if I'm a company who's buying something from, let's just say China, I'm buying it from China, well, I have to get it from China, which is shipping time. Then it's going to come into a port. I'm going to have to import it. I'm going to have to put it on a boat. I'm going to have to put it on a barge, truck. All of these prices are still coming to me. I'm paying for them along the way. And just look at where we are on the month over month. So even though month over month came down, it's still up month over month, and it keeps compounding on itself. So then when you look at the year over year, you can see that, yes, there was that dip, obviously 2020, but we've not only accelerated, we've actually blown through it. And instead of, to take out the base effect, if you look at the last 3 months, we have just accelerated through it and seen that acceleration, which again is just going to get pushed off and passed down to the consumer, which is why when we look at the U.S. break-even rates up and out, this is going to be something that we're going to continue to see with these rates driving higher, because people are starting and continuing to price in inflation, which is why we think these U.S. break-evens are going to continue to go up, which is going to drag real yields up. And remember, the 10-year is so important for emerging markets. So as India struggles, as China tries to tighten up their belts and cut that liquidity, tighten monetary policy, this 10-year going higher is going to make their borrowing more and more expensive, which again is going to limit how quickly we get a renewal in the global economy. And speaking to renewal in global economy, you have to look at, what is my PPI? What prices are the producers seeing? So April PPI inflation higher than expected at 6.2% versus an estimate of 5.8%. And this is it just continues to compound. And that's why we keep looking at it, because yes, there's the year over year. Yes, we see the dip. But even when you take out the year over year and you look at month over month was up 0.6%. Core PPI 0.7% month over month. So we continue to see this drive, because month over month is just showing you the gauge. Year over year, you have the base effect, but where are we going? What is the trend? And the trend remains up, which again is going to put pressure on the underlying price and the consumer, which is why when you look at, and just to round it out, you look at the consumer and the estimates, this is where we're seeing this bifurcation in terms of just sentiment starting to fall and inflation expectations going higher. All of these things are going to impact how quickly are people willing to spend, because if you think inflation is going to go up, you're unsure about your taxes, what are you going to do? You're going to save a bit more. You're going to try to cut back. You're going to try to tighten your belt a bit. And this is where we get this separation of, well, how quickly will people spend their savings? And in the Econ show next week, we're going to look at savings. We're going to look at normal trends, but you have to appreciate who has the savings. Is it the top 10%? And if it is, did they really stop spending what they were normally spending? And the answer was, yeah, a bit. They did. They stopped spending some, but those, as they start to come back, which they have, we've seen a 10% rise in airline prices. Still cheap, but still a 10% increase. Same can be said for hotels and concerts. So that, yes, you're going to get that, but people that the other 50 to 80% of America wasn't doing that all that much already. So what are their savings? So if you're getting some of that additional, that savings is just going to stay there and not get cycled back through, which again leads us to consumer spending, but not just in the US, but what is happening abroad, because we continue to see pressure on the global middle class. So I know we talked a lot. If you have any questions, please let us know. A lot of you have been great hitting us up on LinkedIn, on Twitter. We've had some great conversations on Twitter. Always happy to engage and have a back and forth, and same in the comments. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Have a great weekend.